Welcome back to Intelligent Investment Today, the podcast concerned with all things value investing. In each episode, we take a topic from the world of investment and try to apply the lessons as laid down by the man widely considered to be the father of the craft, tutor and mentor to Warren Buffett, the late great Benjamin Graham. In this edition, we're taking a deep dive into one of the most monumental events to hit markets in recent years, the 2008 financial crisis. We'll look at its causes, its impact, and ask whether we've really learned anything at all. We'll also consider whether the value investor is better placed than the average investor to foresee such market storms, and what they can do to protect themselves when history inevitably repeats itself. So without further ado, let's dive right in. As ever, strap in, sit back, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. We've covered plenty of market events on this podcast before, but as far as I can remember, and please correct me if I'm wrong, we haven't yet examined what was arguably the most severe financial crisis of the modern era. The 2008 crisis wasn't just another dip in the road. It was a complete seizing up of the global financial system. A moment when, for a few weeks, it genuinely looked like the world's economic engine might stop turning altogether. And as is often the case, with the benefit of hindsight, it's easy to shrug it off as a freak accident, a once-in-a-century event. But to those who lived and worked through it, the panic was very real. Unlike most stock market crashes, which are often sparked by over-exuberant speculation, or a bull market that's run out of steam, this one was rooted in something far more fundamental: property, the place people considered safest of all. For years leading up to 2008, the US housing market was in full swing. Between 2000 and 2006, house prices soared by around 85%. Everyone from homeowners to big financial institutions believed those gains were permanent. You couldn't go wrong with bricks and mortar. And that belief set off a chain reaction. Homeowners were happy to take on massive mortgages, and lenders were more than delighted to offer them. After all, if property prices only ever went up, what was the risk? Banks relaxed their standards, granting 100% mortgages, no deposits required, and some even added features to make borrowing easier. Interest-only periods, adjustable rates, and low introductory offers. Of course, when competition heats up, standards drop even further. Lenders began offering loans to people with shaky credit histories, the so-called subprime borrowers. These were people who, under normal circumstances, would never have qualified for a mortgage. But with the housing market seemingly unstoppable, the thinking was simple. Even if a few borrowers defaulted, the rising value of the underlying homes would cover the losses. To make matters worse, those loans weren't just sitting on bank balance sheets. They were being bundled together into mortgage-backed securities, sold to investors all over the world. These bundles were often stamped with top credit ratings, even though many of the underlying mortgages were, frankly, junk. In other words, risk was being disguised and distributed throughout the financial system. The banks that created these securities were making enormous profits. The rating agencies were happy to oblige, and the buyers thought they were picking up safe, high-yield investments. Everything looked fine, until it didn't. When interest rates began to rise in the mid-2000s, those teaser mortgage rates started to expire. Suddenly, borrowers who'd been comfortably making payments at 2 or 3% were hit with rates double or even triple that. And many couldn't cope, and defaults began to mount. At first, it looked like a localised problem, but as foreclosures surged, the flood of repossessed properties hit the market, driving prices down sharply. Because so many loans had been written with little or no equity cushion, millions of homeowners found themselves in negative equity, owing more than their homes were worth. That was bad enough. But the real disaster came when the financial institutions that held all those mortgage-backed securities realised that the assets on their books weren't worth anywhere near what they'd paid. Confidence evaporated almost overnight. Banks stopped trusting one another. The normal flow of money between institutions, the lifeblood of modern finance, froze solid. Then came the tipping point. Lehman Brothers, one of Wall Street's oldest and most prestigious firms, collapsed under the weight of its exposure to subprime mortgages. It was the largest bankruptcy in US history, and the shock was felt around the world. Within days, panic spread through global markets. Because the system was so interconnected, problems in US mortgage finance triggered bank runs in Europe, Asia and beyond. Stock markets tumbled. Between October 2007 and March 2009, the S&P 100 lost more than half of its value, one of the steepest declines in history, rivaling even the crash of 1929. For a while, it looked like we were heading straight into another Great Depression. But this time, governments and central banks responded with unprecedented force. Trillions of dollars were pumped into the system to stabilise banks and to restore confidence. Interest rates were slashed to virtually zero. Quantitative easing, essentially creating money to buy assets, became the policy of the day. And for the most part, it worked. Slowly, painfully, markets stabilised and economies recovered. In the years that followed, regulators imposed strict new rules to prevent a repeat. Banks had to hold more capital, lending standards were tightened, and the Wild West days of mortgage finance were supposedly behind us. But here's the thing, memories fade. It's now well over a decade since that crisis, and already we're hearing calls to loosen regulations in the name of growth. Some argue that rules have become too restrictive, holding back lending and innovation. There may well be some truth in that, but there's also danger. Once you start unpicking the safeguards, you risk opening the floodgates once again. The root cause of the 2008 crisis wasn't just bad mortgages. It was human nature, the same mix of greed, overconfidence and denial that has fueled every bubble in history. Whether it's housing, tech stocks, tulip bubbles or crypto coins, the psychology is the same. Everyone wants to believe that the good times will last forever. And as with any good party, no one wants to leave until 1 minute to midnight. Then, all at once, the rush for the exit begins, and chaos follows. The uncomfortable truth is that there will be another crisis of equal magnitude at some point. It won't look exactly the same, but the story will rhyme. We were lucky in 2008 and 2009 to have leaders like Hank Paulson and Ben Bernanke, who took swift, decisive action. The bigger question isn't if another crisis will happen, it will, but whether we'll have the right people in place to deal with it when it does. So what might the next bubble look like? It is of course impossible to say for certain, but if I had to take a guess, I'd point to artificial intelligence. Right now, AI is being hailed as the next great revolution, and everything is priced in for an AI-powered golden age. Driverless cars whisking us around, algorithms running businesses, chatbots solving every problem, so we can all sit back and enjoy the good life. So let's pause for a reality check. We've heard this tune before. Think back to the dot-com boom of the early 2000s, when anything with .com in its name was a license to print money. Or the current crypto craze, with people convincing themselves that digital coins are the future of finance. Now, I'm not saying that AI isn't transformative, it clearly is, but markets have a habit of getting ahead of themselves. Just because something has potential doesn't mean it will instantly translate into profits. What if people decide they'd rather drive themselves? What if they value human connection over automation? And when that realisation hits, that maybe AI won't change everything overnight. It won't come gradually, it will come suddenly. The same investors who can't get enough of AI today could be rushing for the exits tomorrow. Which brings us to the heart of the matter. What can the value investor do to protect themselves? Well, the truth is, they can't avoid every storm, but they can prepare for them. A value investor accepts that the markets will rise and fall. Rather than trying to predict the next crash, they focus on what they can control, buying quality businesses at reasonable prices. And that discipline provides its own protection. By insisting on companies with strong balance sheets, steady earnings and modest debt, value investors stack the odds in their favour. When the next big downturn comes, and it will, those companies might see their share prices fall, but they're far more likely to survive and recover. That's because they're not dependent on external funding or speculative hype to stay afloat. Of course, Benjamin Graham called this concept a margin of safety, buying enough cushion that even if things do go wrong, you're not wiped out. It's not glamorous, but it's what keeps investors standing when others fall. Crises will come and go. Markets will panic, bubbles will burst, and confidence will crumble. But history also shows that recovery always follows. The key question isn't whether your portfolio goes down. It's whether the underlying businesses you own can survive long enough to see the rebound. The companies that make it through, those with real earnings, solid assets, and prudent management, tend to emerge stronger. And that's where the patient, disciplined value investor wins. Because when everyone else is running for the exits, the value investor is calmly taking stock, assessing intrinsic value, and waiting for the moment when quality can be bought at a discount. That ultimately is the timeless lesson that Graham left us. Invest with discipline, protect the downside, and let time and value do the heavy lifting. That's all for today's episode of Intelligent Investment Today. I do hope you've enjoyed it. If you have, please do consider subscribing or adding us to your playlist. And do continue to spread the word. It really does make a huge difference. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.